Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's June 27th, 2023. We're diving into another really important megatrend today, and that's robotics, automation, supply chain. Wrap that all together, sprinkle on a little artificial intelligence. We got one hell of a big megatrend taking off right now. We're going to dive into that and much more coming up right now on Making Money. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says, we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you'll want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report. Again, this is Matt McCall. Thanks for joining me. It is the 27th of June, 2023, and a beautiful Tuesday morning down here in Nicaragua. Well, not so beautiful as it is a bit raining this morning, but it is nice to get some rain from time to time to keep things green. As I mentioned, we're going to jump into another kind of hot trend, and one that matches up well with follow-up on the show I did recently on the megatrend that is artificial intelligence. With artificial intelligence, it's going to converge with many other innovations out there and create other mega trends that we talk about now, then some that we may not even can see right now, or things that are just concepts in the future. But artificial intelligence, as I've mentioned many, many times, its tentacles will spread wide and deep and really affect almost anything that you're considering investing in the next 1 year, 2 year, 10 years, 20 years, and beyond, because it is here to stay. It is a true megatrend. But within that, there's an area that I've talked about in the past, and I've written about many, many times, and it doesn't get as much fanfare, let's say, as AI, but that's robotics. It's also referred to at times as automation. And I threw the word in supply chain in the open because with robotics and with automation, a lot of times that will affect what we call the supply chain. I had a call recently with some junior operators talking about some ideas, and one of them brought up the term supply chain. And I kind of smirked a bit and I said, it's kind of funny because before the pandemic, the word supply chain wasn't really that popular. You don't have the average person talking about the supply chain. You can also look at earnings reports that come every quarter from companies, and suddenly supply chain was mentioned many more times because there was true supply chain issues. Because with the pandemic and a government-induced shutdown, logistics took a big hit. We couldn't get parts we needed from Asia or from Europe and vice versa. They couldn't get parts from us. So suddenly this supply chain was completely jacked up. And it led to certain products not being able to be built because you're missing the microchip that goes in it. You're missing, a part that goes on to, an engine. It was so many different things, and even to food. The food supply chain was messed up. So that's been something that is not quite as spoken of at this time. However, it still is something that we need to consider. You add in that a term a term has been around many, many years, but has become more popular as of late, and that's called onshoring. I like to call it nationalization as well. And that means that instead of relying on parts coming from Asia or maybe places around the world that aren't quite allies with us, that we onshore that. That means we bring those factories and the production of those parts that are needed back to the United States, or at least somewhere in North America, whether it be Canada or Mexico, with nations that we have good relations with at this point. So again, how does this all relate to robotics and automation? Well, because a lot of times we don't have the workers to run these factories, these big industrial parks. So we need automation. We need robotics. Think about this too, how much it costs to bring in potentially a skilled worker, pay their benefits, etc. They have sick days. They have sometimes just not the best workers. Maybe you can't even find that worker. A robot, a lot of times your return on investment over a period of time ends up being very positive because you don't have to deal with sick days. I mean, yeah, robots break down, but you have somebody there to fix it. So it is a bit different, having a factory run on automation, robotics versus all purely humans. But even the factories that still have a large human base have all. I wouldn't say all. I'd say if you haven't, you're probably going to be shut down soon. So I'm going to say they all have somehow converged robotics and automation, and even some AI with the humans. So it's been there for decades. Actually, in 2022, it was the 60th anniversary of the world's first industrial robot. So you can see how long it's been around, over half a century at this point. But what's pretty interesting is in 2022, out of every 10,000 employees in the manufacturing industry, there was 141 robots. Global X, which has a robotics ETF, I'll talk about a little bit later, they came out and they said within a few years, they think they could hit 500. So that would be obviously about 3X in a matter of several years, more robots, 500 robots for every 10,000 employees. And there's a big reason we're starting to see a tick up in this. The reasons I just mentioned: onshoring, supply chain, nationalization. Also, we've gotten to the point where technology obviously every year gets better and better. Processing speeds get faster and faster. And as that happens, costs go down. So technology improves, costs go down, make it more cost efficient and more realistic for a lot of corporations to incorporate robotics into their business model. I talked about labor. We have labor shortages, folks. We just have people that do not want to work certain jobs. And so you need to replace them. We also have, not only here, but in Japan and Europe as well, there's populations that are aging, and they're aging quickly. So they're no longer able to fill some of these factory jobs. So they have to replace, again, leading to labor shortages. So all that stuff I mentioned is our catalyst for the future of robotics, on top of the fact that we were moving there already. As I mentioned, it's been 60 years since the first industrial robot was introduced. ARK, which many of you know, ARK Investment, they put out a, not on top of the ETFs that you all know about and the funds, they do some great research, and every year they put out what's called their big ideas. So the 2023 big ideas from ARK, there was a couple sections on robotics and automation. They believe that the autonomous logistics part of this, and logistics part is going to be, once everything's manufactured, taking that part or taking that good or that thing and getting it to where it needs to be. That's the logistics part. They believe that could hit between $1 to $2 trillion of addressable market by 2030. And that's basically going up from not much at all right now. I mean, there's some autonomous logistics, but not much. So that could be a huge market, $1 trillion market in just 7 years. You break that down and look at, like, for example, robots for grocery delivery. Sounds crazy, but you've seen the videos. It's going to be real. And if you take a look at grocery, just as an example of groceries in particular, e-commerce for groceries could hit 35% of sales by 2030. It only makes about 6% now. Then you look at the fact groceries are an $11 trillion market. So if you start putting in, okay, well, what about food delivery via groceries delivery via robots and drones? Well, if you add in parcels as well, which means like UPS, FedEx, suddenly by 2030, this is potentially a $740 billion business. And parcels is the biggest part of that, not food delivery and groceries. Parcels is the biggest, but this is all robotics. This is all automation, folks. Everything from autonomous big semi trucks, which Tesla is working on and other companies as well, to drones, to the robots in the factories. You go through this whole supply chain, and it's all going to be automated at some point in the near future. It's something you don't want to give up on, an investment you don't want to give up on. And I'm going to throw one more kind of wrinkle into that, and that's 3D printing, which had a really good run. Man, it's maybe 12 to 15 years ago now, when everybody thought that we'd all have our own 3D printer. So if I need a fork, I'll bring on a fork, or whatever the heck it might be. I need a whatchamacallit that goes on the back of the TV. I could print that out because I forgot it, whatever it might be. That did not become the case, and I don't know if that's going to be the case ever. However, industrial 3D printing has been taking off, and it's going to continue. And again, ARC looked at robotics and 3D printing combined, because the 3D printing, again, I'm going to sprinkle in some AI here. The AI can create whatever you need, help it do it, but you need the robotics, and 3D printing is basically robotics to make the goods and then get it to where it needs to be. So all this stuff converges together. It sounds that you can go from 3D printing to artificial intelligence to robotics to automation, supply chain, logistics, all ties in, all automated. And ARC believes that combination of robotics and 3D printing, which 2022 had a value of $70 billion, could grow at a compound annual growth rate of 80%, 80, which would take it to $9 trillion by 2030. I think that's a little ridiculously high. All that said, man, oh man, if it even comes close to that, just think about the upside potential again. And this involves robotics, 3D printing. So yeah, it's out there. I mean, this is definitely something that's real. And if we take a look now, the big thing that people talk about is robots replacing people. Could we have a factory at some point in decades from now that are all actual robots that move like humans? Sure. We're not there yet. When I talk about robotics, it's more about a robotic arm. And we're going to talk about some companies that make these and some specific examples going forward. But if we take a look at items that can be picked up and placed per hour, and we look at robots and the performance, how it's improved, I have a chart here for you. And this shows just how the advances have taken place in robotics. So go back to 2015. This is the items picked up and placed per hour by a robot. You can see it's in the mid to low double digits in 2015. 2016, you're now over 100. 2022, we're now around 1,000. So you can see the really, really big gains. And, we've now passed the humans, which around 2022, last year, humans do about a little over 400 items picked and placed per hour, potentially. Robots now more than double that, almost triple that. So you can see, why robots do make sense here. And then we can look at Amazon in particular. And this shows the number of Amazon robots and employees, and this is in the thousands. So back in 2013, there's about 1,000 robots and about 88,000 employees. Fast forward to 2022, the number of employees has increased by about 15x from 88,000 to about 1.6 million. But at the same time, the number of robots has gone up over 500x from 1,000 to 520,000 last year. You can see in that chart. So I don't see that ending anytime soon either. These are trends that at some point there'll probably be more robots than there are people. In some situations, it would actually probably make sense. The ARC also comes down to believe that the enterprise value for next-gen manufacturing, which again, next-gen manufacturing, we can throw some 3D printing in there as well via robotics. It's going to grow from 63 billion in 2022 to 8.4 trillion in 2030. Which is, again, it's just unreal numbers. And then, you take, like I mentioned, artificial intelligence. You converge that with the 3D printing, with the way that material science has improved. And we look at what could be potentially upending, manufacturing itself is a $12 trillion industry. Even getting a part of that with robotics and artificial intelligence and automation, 3D printing, all that stuff combined. Again, you're looking at trends, folks, that you could buy these stocks today. Let's say, for example, a basket of stocks that has all these areas covered, from 3D printing to automation to robotics, artificial intelligence, etc. You buy 20 stocks. Obviously, you have to do your research, get that down, and 20 stocks you believe in, 20 companies you believe will be much bigger 10 years from now. You always have to ask yourself that. Will be bigger? Because if it's bigger, most likely the stock's going to go up. I mean, the market cap's going up. Doesn't always work that easy, but it's a simple way of looking at it just for this discussion. That being said, that basket in 12 months or 18 months or 24 months could be down, because these are long-term plays. But this is a trend, mega trend, that's going nowhere. There's some huge growth behind this. And again, the growth doesn't go straight up. You're not going to grow 80% a year forever. It just doesn't happen. However, along this journey, there's going to be a lot of companies that will, at one point, be some of the largest companies in the world. And you want to own them. I'm going to talk about a company in a minute that's a robotics company in healthcare that was one of the first stocks I ever bought for clients in 2004 when I had my money management business. And it's up well over 100x since then. So we'll talk about that in a minute. But a couple other examples here. Deere. We all know Deere, right? The green and yellow logo, agricultural agricultural equipment company, symbol DE. They had a presentation in 2022, and one of the executives came out, and this is a quote I'm reading right now. It said, "We're able to develop new robotics and artificial intelligence products much faster than anyone in the industry. And this sets us up to unlock the $150 billion of incremental addressable market. We are now set up to become a world-leading robotics and artificial intelligence company." This is Deere. As a kid, I think of Deere, I think of a riding mower. You sit on a riding mower, a green mower, or even just a regular mower. You have to pull the cord. And of course, farms. I didn't work on a farm. They're everywhere in farms. But they've said now they planned out a fully autonomous corn and soybean production system by 2030. That means going from the tillage to the planting, spraying, harvest, and fall tillage. All this is done automatically, autonomously. What do you need for that? Robotics. So again, I just want to give an example of areas that you think you would not see robotic get into. They're already there. 2020, had to be 2020, I guess, right before COVID. 2020, I was in Vegas for CES, and I sat in one of these huge Deere tractors that they use on large farms, and they had AI incorporated into them. I mean, all the robotics moving and sitting, and look like you're in a cockpit of a very sophisticated jet. They now have ones that are autonomous, and they're controlled from a phone, basically. Again, that's a robot. These are robotics. So when you think about robotics, don't just think of this like, they're made from the Jetsons. It's not just that. Supply chain, we talked about already, but there's a number that I saw that kind of blew my mind, that if you combined AI, work automation, and robotics all together, how it could really affect the supply chain, that could add up to 3.3 percentage points annually to global productivity growth. And you think about that, that's globally how big it is. That's, looking at economies that are worth trillions and tens of trillions of dollars. 3.3% is a big deal. And again, a lot of winners come out of that on the stock side, on the investment side. So let's jump into that now. I got 7 stocks that, again, nothing here is a buy or sell recommendation, nothing of that sort. But these are stocks that I think if you're starting to look at the robotics and automation area, these are some of the leaders. And I'll tell you about each one, and you do the decision if you wanted to go forward and do more due diligence. But these are companies that are definitely big players in this industry. So the first company is ABB. Used to be traded here in the United States under the symbol ABB. It's not anymore. It trades overseas. It's a Swiss company. However, they do trade here as an ADR, American Depository Receipt. The symbol is ABBNY, as in New York, ABBNY. It's about a $71 billion company. It's a world leader in industrial automation systems. It's an old company. It was founded in the late 1800s. That's how long it's been around. It was a merger of 2 old industrial companies by the name of ASEA and BBC. To be honest with you, never heard of them. But it's either number 1 or number 2 supplier in all of its core markets. And when it comes to robotic arms, obviously, we see those in everywhere from, we'll talk about healthcare in a minute, to manufacturing automobiles. Number 2 robotic arm supplier globally. So obviously, they are a company that you want to keep an eye on due to that. And I'm going to show you the performance of all these stocks in the last year in a little bit once I go through them. Keyence, which is KYCCF, again, trades here as an ADR, $115 billion company, Japanese company. They're a big name when it comes to automation robotics. They're involved in sensors. Laser imaging is a big thing when it comes to robotics. Range finding technology, robot mobility. They sell factory automation sensors, machine vision, even barcode readers, measuring instruments, digital microscopes, you name it. But pretty much a pure play robotics company. Based here in the U.S., Rockwell Automation, symbol ROK. They are a global producer of factory automation systems, $36.6 billion. They're pretty much a pure play automation company. They were a successor to the entity of Rockwell International. You probably have heard of that, which was spun off of Rockwell Collins, which is an aviation company back in 2001. And they have three different areas. They look at intelligent devices, a lot of robotics, software controlling robotics, and then life cycle services as well. UiPath, which is a newer company, symbols PATH, P-A-T-H, $9 billion company. They provide what's considered an end-to-end platform for automation, and the users are able to be part of that. So their platform is basically built to be used by the employees of the company. And they address, the different things as far as use cases, from simple tasks to some long-running complex business practices. But they're not your typical robotics company, but the software, and they do have some hardware behind it. And again, pretty interesting. It is profitable, even though it's a newer company. But about a $9 billion company. FANUY, which is symbol FANUY, $33 billion company. This is also a Japanese company. You'll notice Japan has always been the clear leader when it comes to robotics, and they're not giving that title up anytime soon. FANUY makes factory automation products. They do industrial robots, control systems, you name it. YASKY Electric, symbol YASKY, about a $12 billion company. Again, Japanese company. Motion control components, industrial robots. Again, very similar. A lot of these companies are direct competitors and very similar products. Symbotic. This is a newer company as well. Symbols SYM. I'll give you a full disclosure. I owned this company for myself for a while. I sold it and it kept going up. It would have been way more than a double. I made some good money, but it kept going. It's pulled back as of late. It's a $20 billion company, symbol SYM. It does motion control components. And if you think about it, when you look at Symbotic, their big thing is taking care of warehouses. You see those things moving around, like an Amazon warehouse and moving things. They have agreements with some really large client-facing companies, some large retailers. This is a company I find really, really interesting. It's grown quickly. It's up to $20 billion. And this was actually a SPAC, one of the few SPACs that's actually well up. It's close, it trades in the high 30s now, but SPACs are at $10. A lot of them are trading at $4. So this one has actually held up very well. Again, a little more aggressive on this stock. And again, nothing here is buyer sell recommendation. Just because I owned it in the past doesn't mean you should own it now. All that being said, it is a company that is on the cutting edge of really warehouse automation. And the last one is a company that I mentioned before. This is Intuitive Surgical, ISRG. They do the robotic systems for minimally invasive surgery. It's called the Da Vinci system. There's now been nearly 7,000 Da Vinci systems placed in hospitals around the world, about 4,000 here in the U.S. There's more and more growing emerging markets all the time. Amazing business model. As I mentioned, it's about a $115 billion company right now. And what's pretty crazy is, I mentioned this before, I'll tell you the quick story, is that 2004-ish, I started Penn Financial Group. And at that time, get a couple winners under your belt and you feel good. I only had a few clients at the time. And and Penn Financial was a money management, a registered investment advisory, so I managed people's money. I remember it had to be around 04-ish time, buying Intuitive Surgical. and it was a little less than a $1 billion company today. Then, went up to 130, and now it's at 115. So it's over 115x bigger than it was then. Just think about that. A $10,000 investment was 1.15 million. Bought it for clients, and again, these numbers are fuzzy, but within reason, I'd say within 3 months, it was probably up 50, 60%. I thought, wow, you annualize that out. I'm a genius. I better take this and run. Little did I know, I left about 114x on the table. So you learn your lessons to let the winners run. You learn the lesson that if you're in a mega trend, things don't go straight up. And there's been since 2014. The other thing is, would I have held on the whole time? No, obviously I didn't. So I can't say that at all. But you go back to 2014. 2004, not 2014, 2004. Since that time, there's been several pullbacks of 30%. There was one pullback in the 08-09 Great Financial Crisis of 75%. There was then another one of 30-some%, then another one of 40, then another one of 35, then another one of 50 just in the last couple of years. So you have to hold through all these ups and downs and do it. It does pay off if you're right long term, but my point is you kind of have to sit back and have some pretty thick skin to let that happen. So let me show you a chart here. If I just over the last year of how all these stocks have done, and as you can see, all but one, all but UiPath is up over the last 12 months. With the Symbotic, as I mentioned, the one that's been running as of late, being the winner, up 170% over the last 12 months. But majority of them are kind of baked in between 36 and 58%. So again, this basket of stocks would have done really, really well in the last year. And if you think about, well, how's it done versus everything else? The S&P over the last 12 months is up about 11%. So you take that into consideration, 11%, and you take these averages. This has to average, I'd say, somewhere around 50%, if not higher. So blowing the doors off of the S&P over the last 12 months. Again, none of this performance of the past is any indication where it's going to go forward in the future. But again, you take a look at this, and these stocks have done really well. So there's also an ETF. There's a couple of ETFs out there. There's one called BOTZ, B-O-T-Z, which is Global X, which I think year to date is actually up over 30%. So it's done very well, a little better than even NASDAQ's done. But they have some AI-focused companies in there. NVIDIA's a top 10 holding. So you're going to get some push off the AI as well as robotics. So there's a lot of ways to get exposure to this area. Just keep in mind that when you think robotics, don't think negative. Don't think somebody's taking your job. Don't think they're going to take over the world. Don't think of it as just made in the Jetsons. Robotics might just be an arm, a robotic arm. It could be a lot of different things. It's automation. It's upending supply chain, which needs to be upended. And then you mix in a little AI, and you have a pretty amazing megatrend that cannot be ignored if you're an investor. So I want to put that out there, and I want to get to a quick, sweet, get some education in there for you, get some fun, and hopefully make some money with some of the stock, as we mentioned there. But again, nothing buy or sell recommendation. So again, thank you folks so much. Don't forget to share, like, comment below. Hope you have a wonderful rest of your Tuesday. And Thursday, we'll be doing our mid kind of year wrap up, and more importantly, our outlook for what's going to happen, I believe, in the next 6 months. Lots going to be going on next 6 months here. So make sure you tune in for that on Thursday. Once again, I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.